Hello and welcome to Tasplan's quarterly investment update. Now I'm David Stuart, I'm the new Chief Investment Officer here at Tasplan, but I'm not new to Tasplan. I've actually worked for Tasplan for over 12 years as their asset consultant, so I've helped Tasplan over that period devise its investment strategies and choose its fund managers and so forth. So I know the fund very well. And what's more, I have been a Chief Investment Officer before. So through my career, I've been Chief Investment Officer both of fund management organisations and also large institutions like Tasplan. So I'm looking forward to helping Tasplan deliver great investment outcomes for its members. Now, I thought I would update you on what's happening in financial markets. We're currently at the end of August in 2019, and after a very strong first half in terms of fund returns, we've seen some volatility, and in fact we've seen some negative returns coming through in various financial markets. And I guess that is always of some concern and causes people to ask what's happening and whether this is going to continue. Now, I thought we'd start by looking at the global picture. And clearly there is slowing growth around the world. We're seeing this in the US, we're seeing it in Europe, and we're also seeing it in China. And generally equity markets prefer strong growth to weak growth, so that's a bit of a concern to them. Probably more importantly, the continuing tariff wars between the US and China, I think, are causing a lot of people to question where this will end. So we're seeing the US raising the tariffs it's putting on China, China to some extent retaliating by raising the tariffs it's putting on US goods exported to China. Markets don't like tariffs. In general, tariffs are considered to be damaging to global growth and to global trade, and they're therefore not very good news for the corporate sector around the world. Finally, in terms of global worries, in Europe at the moment, Britain seems to be moving towards a Brexit which could be a no-deal Brexit, which I think most people believe would damage growth both in the UK and in Europe quite significantly in the short term. So there's quite a lot of things to worry about, and that's one of the reasons I think markets have had some setbacks. On the other hand, against this backdrop, we've actually seen interest rates falling around the world. So the US, which raised rates quite significantly over the previous few years, actually has started to cut rates again, and the market expects further cuts to come. And of course that provides support both for economic growth, but also direct support for financial markets, because it helps the valuation of things like equity markets and property markets. So I think that the reduction in interest rates, together with the possibility that the trade wars could actually result in some kind of deal between US and China, are the things which are giving some upward movement to markets to offset this sort of downdraft coming from the economic factors. What about Australia? Well, I think it would be fair to say the Australian economy at the moment is really muddling through. Growth is sluggish rather than very low, but it's certainly a bit below trend. And as a result of that, the Reserve Bank in Australia has also started to cut interest rates. And that, I think, has provided some support again, both for our bond markets where yields are very low, which means their capital value has risen, and also for our equity market. We also think that the housing market is showing some signs of bottoming in Australia as a whole, and particularly those leading markets in Sydney and Melbourne. There's some signs that activity may be picking up a little, and we may have reached a bit of a floor, which may help consumer spending. Now, the outlook for Australia, I think, is really an ongoing sluggish growth environment. We don't think things are going to pick up strongly, but nor do we think that the threat of recession is significant at this stage, unless that was triggered by a global setback. And the global setback, I think, would be if what's happening at the moment on the trade front actually escalates a lot further. So recession, we would say, is not our expectation, but we do need to recognise it is a risk, and that those risks are rather higher than we would be comfortable with. Now, in terms of Tasplan's portfolios, I would stress that all of our multi-asset portfolios are very well diversified, so we don't only own equity markets and government bonds. We own a host of other assets which provide some level of diversification. And in particular, we have an increased level of unlisted assets nowadays than we had maybe 5 or 10 years ago. So that's unlisted property and unlisted infrastructure, which are generally providing quite strong income and are not necessarily susceptible to this volatility which is impacting equity markets. As far as the portfolios are concerned, we've generally been reducing the risk over the last couple of years as we've seen equity markets in particular reach new highs. So as prices get too high, we will typically take down our positions. And there's other areas in the portfolio where we've also been focused on limiting risk, as generally investment assets have become fairly expensive. Now, in the volatility, we'll also look for opportunities. There's times when assets can become oversold and you use that as an opportunity to increase your exposure to them. So I would say that it's not all one way, but we've certainly got a mind to try and keep the risk managed at the moment in a return environment which we see as being a difficult one, albeit we would still see modest positive returns coming through over the next year or two for the funds. Thank you for your time.